Ladi, thank you for joining us today. Bring us up to speed on what you know so far about this auction.
Hi, good afternoon. Thank you for having me. So generally speaking, would like to see a bit more activity than we've seen in the preceding auctions, although that's unlikely to be the case given the weak appetite for bonds going into the month of April. At the last auction, we saw the 2027 bond print around 10.5% as it stands. We're trading significantly higher, around 12% on this instrument. For the two longer tenor maturities, that's the 15-year reopening and the 25-year bond. That's the 2035 and 2045 bond. Stop rates closed at 11.5 and 12%, respectively, at March's auction. So going into today again, where we have another auction where 150 billion will be offered across the tenors, we expect that the stop rates on these instruments will close significantly higher than where they closed at the previous auction to reflect current market realities. As it stands, both these instruments, the 35s and the 45s, are currently trading well above the 13% handle.
Now, if this trend does continue, because I know that, last year, and of course, the whole essence of why we saw rates decline in the first place was because the CBN, the monetary authorities working with the fiscal authorities, are trying to bring down the debt service levels, which of course went to very high levels. Now we're seeing this continuous uptick in rates. At what point do you think we could see a pullback from the side of the CBN issuing?
Okay, well, last year was definitely an anomaly. We saw a downward trajectory in rates month on month all the way to the end of the year. And I'd like to say CBN and the DMO were relatively successful in reducing the cost of their debt. But going into this year, we're in a more desperate state as a nation, if I'm being honest, with the increased need to borrow funds, whether local or international funds. And because of this, given everything else happening in the economy, the FX space, as well as the illiquidity in the system, I don't think that the DMO have much of a choice but to follow the market trend and raise funds regardless of the rates that we're seeing in the market at the moment. As it stands, inflation has been on the rise consistently over the last couple of months. Right now, we stand at a 4-year high at around 18.17%, which was reflected in March's CPI report. So as soon as the inflation reverses, the FX situation of the country in terms of the paucity of funds within the I&E window and all the windows within the FX space, until that burden is relieved, and also the offshore counterparties being able to repatriate their funds with relative ease, we'll continue to see an upward trend in these yields as nothing fundamentally has changed. The need to borrow is still there, and the maturities which have come over the last 3 months, the first quarter of the year, have thinned out going into April and throughout the rest of the year. So as it stands, the DMO really doesn't have much of a choice if it wants to continue the pace of borrowing in which is set out for Q2.
Okay.